So again, I'm Brianna Rossett, the Office and Events Coordinator for the Small Business Center. Welcome to 2022's Strengthen Your Business Core, an annual event that targets small business community in the Bay of Quinte region. This event is hosted by us, the Small Business Center, year after year, where you get the chance to learn, network with the attendees and speaker. This virtual event is a spectacular opportunity for entrepreneurs to connect with business leaders, gain firsthand knowledge from today's experts. Today's event brings together businesses within our area and various stages of development for an open exchange of ideas, advice, and feedback led by today's speakers. Today, this event would not be possible without our two amazing sponsors. We have Trenval, and Amber Darling, the Executive Director for Trenval, is going to speak on behalf.
Thank you, Brianna, and thank you for all the attendees for taking time out of your day today to learn a little bit and build some personal goals as well as your business goals. Trenval is a proud sponsor of the Small Business Center and the events that are hosted. And just a little bit about Trenval, we do provide business counseling services. We provide financing. If you have an opportunity to obtain some financing from us, we are with you for the whole duration. Different than a bank, we do accept clients that have actually been declined by banks. And that's where our mandate from the federal government is. So pleased to be here today. I will be listening in and strengthening my core as well. As you strengthen your core, you'll be able to provide better business services to your customers. So thank you, Brianna, for inviting Trenval to be here today.
Thank you so much, Amber. I would also like to say thank you to Center for Workforce Development. We have Brad Labadie, the Executive Director, here to say greetings as well. And thank you again for being a sponsor.
Good morning. Thank you, Brianna. And thank you, Amber, for helping co-sponsor this. Good morning, everyone, and thank you for taking time out of your day. I know how busy it is. We're all busy. Technically, Center for Workforce Development is a business, and we're busy, as many are. Many of you are struggling through this pandemic, and I think this is a great event to help you not only deal with what you've been dealing with through the pandemic, but to hopefully help you grow. As Amber mentioned, you know, they sponsor a lot of small businesses, and I can contest to that they do great work. So the only thing I want to mention, two quick things here. One of the things we're doing to help businesses out there is we've implemented some job search tools for job seekers. So if you go to our website, cfwd.ca, you'll see some great job search tools out there. So as an employer, if you're looking for employees, you should be advertising online because we're going to capture it and we're going to get it out there to the job seekers in this community. The other piece we need to do is we like to understand your struggles as employers. So I will put a link to the Employer One survey that we are conducting right now. It's a demand side survey. We want your feedback. We need your input, your voice, because it's only through your voices that we can put together programming to help you sponsor events like this. And also we are a direct connection back to the government and provide that voice back to the government of what you're saying. So thank you and enjoy your day.
Thank you so much, Brad. With that survey and that link that you are going to put in the chat, I will also send that as well with the recording of today's events. So you do have the opportunity to if you forget about the link or something happens, whichever you weren't able to attend, you're still able to fill out that survey to help our community grow and learn. So I'd like to go over today's schedule just so you have a kind of an idea of what to expect today. We will have breaks in between each speaker. From 9 to 10, we've got John Tuer here. He's sitting here right beside me here in my face. I can see anyway. He's the Senior Assurance Manager for Wilkinson and Company, and he'll be chatting about accounting today. We'll have a 15-minute break, and we'll have at 10:15 to 11:45, we'll have Alyssa Zwonk, founder and CEO of Nomad Creative, and she's going to discuss build your own social media strategy and how to define, build awareness through content pillars. We'll have a 30-minute lunch break, and then we'll have from 12:15 to 1:30, Tenyu Mahida, a human resource manager for Trenton Cold and Storage, and she'll be discussing hiring, retaining, and managing employees. We'll have another 15-minute break. We'll have our last speaker of the day from 1:45 to 3:15, Jack Beach, the manager of Community Engagement Education, Canadian Mental Health Association from Halliburton, Kawartha, and Pine Ridge. And he will be discussing managing your mental wellness during COVID-19. I would also like to mention a few other things. I've kind of already discussed them already, but this will be recorded. So if you're not able to stay the entire time, we completely understand you're very busy. And I'm just very grateful that you registered for today's event. Another reminder, keep your mic off at all times unless you've been asked to unmute. Any questions, please direct them to the chat and I will be monitoring the chat the entire day. And I would like to now introduce John Tuer. John has started his career with Wilkinson in 2001 as a summer student. After graduating from the University of Waterloo with a Master's of Accounting, John joined the firm full-time in 2005. He obtained his full CA designation in 2007 and is now a senior assurance manager in the Belleville office. As of 2019, he is the partner at Wilkinson and Company. The majority of John's clients are nonprofit companies and small and medium-sized businesses that benefit from his ability to identify opportunities that optimize their tax situations, or in case of nonprofits, ensure they meet all necessary regulations to secure funding. John takes pride in the strength of Wilkinson staff with their broad range of diverse skills that allow them to provide solutions for their clients that other firms may not be able to do so. John was the past president of the Belleville Chamber of Commerce in 2019 and an avid golfer and curler. Welcome, John Tuer.
Thank you and good morning, everyone. So as Brianna mentioned, I am a partner here with Wilkinson and Company out of both the Belleville and Trenton offices. Do have a wide range of clients, and I can say, just as everyone is during especially this COVID environment, I more than a lot of people understand all the challenges that people have been facing, just trying to help businesses manage through this. We have been quite busy and it is a quite stressful period. So I understand your challenges. We do have about an hour booked for myself. I can say that I do hope that there is some questions, as basically I don't have a full hour of material that I really wanted to cover, because I do want to be here and available for some questions. So really what Brianna has asked me to talk about is especially really focused on small businesses. Entrepreneurship is really strengthening your business core is the theme of today. And I'm sort of touching on the accounting piece of that. So first off, I just like to start by saying that there are some things that we see sort of with people either joining or starting a new business, people who've been in business for a while, and even people when they're trying to wind down a business. So the first thing I really want to sort of highlight is a lot of businesses that we see, even more so during this COVID period, are really just focusing on the day-to-day operations. A lot of business people, I'll just use an electrician as an example. A lot of people get into maybe a business of having an electrician company because they're an electrician, not because they're a business person with maybe a little bit of interest in being an electrician. It's because they're an electrician. If they're going into, say, a flower business, want to start a flower store, it's because they sort of love that sort of idea of flowers, weddings, all of that. It's not because they're a business person with a little bit of a side interest in flowers. And where I really try to focus on that is what we see a lot of times is that business piece, that accounting piece sometimes gets ignored a little bit on a few different levels. So the first item I wanted to touch on is really budgeting. I can say that in a lot of cases, some of our most successful businesses that we see as clients And obviously for confidentiality reasons, I can't say who those businesses are, but a lot of them where they have success is because they do have a bit of a formalized budgeting process. It helps them manage their operations. It helps them understand how they're progressing over the year. It helps make sure that any big hiccups or any big issues are identified. And it also gives them a buffer for maybe some downtimes. A lot of small businesses, like I said, with people who don't maybe have that accounting background, don't really focus on the budget as much. And really what that does is they may make business decisions that are often maybe not the right business decisions, might be maybe a bit too risky for where they are in their business life cycle because they don't have that budget in place. It can help you understand cash flow better. It can help you understand your income and how your taxes. It flows into your own personal situation because a lot of business owners, obviously there's an end goal of them building wealth for their own retirement and future. So that's the first item I really wanted to highlight is the budgeting. And it's important to forecast, not maybe even if you're starting for the current year, but maybe where you see yourself 2, 3, even 5 years down the road. I can even say that in certain situations, and I'm not here to crush any young entrepreneurs' dreams, but it can say there are certain businesses where we see sometimes the market does not necessarily support what the person's business goals are. So it might help them make a few different decisions. And what I mean by that is you may have a very good business idea, and I know there's a wide variety of people on this call from maybe a few different areas, but for example, you may be in the county and have a really great business idea, but maybe the local market maybe doesn't necessarily support that business idea. So that can lead into maybe decisions, oh, okay, I need to have more of an online presence to help support that little bit of offset as I grow. It may say, you know what, I may need to have something else sort of helping support my own financial needs personally as I grow my business, because that business cannot fully support that, because we often sometimes see people need to take too much money out of the business early on to meet their own personal financial needs. And often there's a bit of disconnect in terms of growth. The one thing with that is a lot of people, when they might start to grow a business, it's often sometimes mirrors their own life cycle when they might try to start a family where they might have some school debt in place. So it's really important to have that budgeting in place. I feel it really helps even enhance success and make strong business decisions. So again, we can take questions at the end, but that is sort of the first item that I really wanted to sort of focus on, is the budgeting aspect, making sure those budgets are realistic. You have a few different options and you really understand a little bit of the business side. You may rely on some experts, whether they be accountants, whether they be the good people at the Small Business Center or Trendval, but really having that in place helps you being successful. The second item I wanted to touch on is even understanding the day-to-day aspect of accounting. And where a lot of people, just as sort of flowing from that budget conversation I had, is a lot of people, they do their work, they think they're doing well, they're working really hard, but don't necessarily understand the day-to-day accounting. And you may rely on some of the experts at the start, but it's important to gain an understanding of that. I would say for most people, really starting, I would recommend getting an accounting software in place, whether that be Sage or QuickBooks, because having that sort of up-to-date, ready information helps you sort of understand where your business is. Because if you don't understand where your business is, then it doesn't help you make those day-to-day decisions. Couple things that we have seen with businesses is one, pricing for sales and products. If you have a small business where you're trying to figure out how I'm pricing my products, is really a good starting point. Is first understanding what your overhead is, what some of your fixed costs are, whether that be rent, whether that be property taxes if you own a property and mortgage, understanding what your monthly utilities are, understanding if you have, say, an administrative assistant who really isn't tied to driving sales, is almost starting with understanding what your overhead is. So whether that be 50,000, whether that be 100,000, whether that be, as you grow your business, $1 million, starting sometimes with what your overhead is, what your fixed costs are. The next item is sort of understanding what the margin is on your sales. A lot of people may be pricing a product and they may think it's fair, but really when they aren't factoring in, for example, all the wages and benefits, they're not factoring in the full purchase, all the purchase costs, they may not be factoring in shipping and other direct costs that really relate to building up their product and or service in certain cases. And they may not establish a proper gross margin in order to, when they factor in how many actual individual units you might want to sell. And again, I'm just trying to give an example that is somewhat generic, but can be really applied across a lot of businesses. Is you don't understand, for example, how much in sales I need to generate at X gross margin in order to A, cover off my overhead, B, cover off the income taxes on that, and C, get to a point of a actual return that I feel comfortable with financially. Some people aren't always focused on the financial aspect. They might be doing something that they truly love, and they may say, you know what, I might be able to make more money doing something else, but I'm comfortable because this is what I love to do. I have control over my job as an entrepreneur or a small business owner. But again, everyone has their own bills to pay. So it's really important to have that financial understanding. So that's sort of on a high level, sort of where to focus on when I talk about sort of the income statement. The second aspect to that, sort of understanding your business, is really a lot of people may focus on, even when they have an accounting software, maybe even if they have a bookkeeper, is they focus heavily on the income statement. They think, how much money am I making? But they ignore what's called a balance sheet. And for those of you who may not have as much of a business knowledge, I do know we have a potentially diverse crowd on this call, is that a balance sheet really takes your assets, which are, for example, your cash, your accounts receivable, your equipment, less your liabilities, which would be any amounts payable to, say, vendors or suppliers, any long-term debt you might have taken out to purchase other liabilities. Is that a lot of focus may not be placed on the balance sheet. And there's a few things that are important, because a lot of times what we find is that there can be a lot of errors on the actual balance sheet, which then ultimately impact the income statement, is because that's where those errors have arisen. Someone's just plugged something in the income statement and balance sheet, and really the balance sheet is wrong and it needs to go somewhere. So what I'm going to do is just sort of walk through sort of just talking about a few balance sheet items and what to sort of look for as sort of especially for someone who's getting into business, even for people who have been in business maybe for 5, 10, 15 years, that sometimes get ignored. And even for people on this call who might be sort of looking to wind down their business. So the first thing is cash. A lot of times what we find, even when people use an accounting software, is that there's what's called a bank reconciliation, which takes what's actually in your bank and reconciles that to your accounting records. And there can be a lot of times a lot of old entries in there that should have been cleared out that just get ignored. They might be old outstanding or duplicated checks. They might be automatic entries that somehow get posted to the reconciliation. They might be outstanding deposits that really aren't outstanding anymore and just have been posted incorrectly. So these are things to look out for when sort of focusing on the actual, what's in your actual physical bank versus what's actually in your accounting software. The next is your accounts receivable. So this is if you have a business that has accounts receivable from customers, is focusing on are you watching to make sure that you're collecting any old and outstanding receivables? Have you ensured that maybe, because sometimes what happens is when people are new to the game is when they get a receipt is they may actually not apply that against accounts receivable. They may post that to sales for a second time. So they may say, hey, my sales are rocking, but without realizing they've actually double counted for a lot of amounts that should have been applied for accounts receivable. If you're going to a place where you want to manage your cash flows, is making sure you have proper accounts receivable terms, and also making sure you identify who are even good paying customers, that if your business is stretched and you maybe need to be in a position where it's like, geez, I can't take on all these customers at this stage of growth. I've got one customer over here that's really taking up a lot of my time, and every time I look at my accounts receivable, they're over 90 days or over 120 days. And I have this other customer who I never see them over 60 days because they always pay. Where should I be maybe focusing my time on a bit more if I'm stretched as I grow my business? Obviously, you don't always want to turn away sales, but if you're in the point where you can't, for example, take on all those sales, you need to maybe make sure that you build up your customer base to be the right sort of customers that you want to be dealing with. The next item that may be applicable for some of you is inventory. And really on your inventory, a lot of people don't maybe adjust day to day for inventory. It's often good for even a small business owner. Again, I know time is precious, but really to understand sort of counting your inventory on a monthly basis. You may identify potential theft issues. You can identify and adjust to your balance sheet in order to properly make sure that you understand how your margins are doing. Because if you're not managing your inventory on a month-to-month basis, or even at a minimum quarterly, you may be missing the big picture on that. So that's just a few things to focus on inventory. If you're in a position where you have inventory that may sit around a while, potential obsolescence issues that you want to get them cleared out, depending on the nature of your business. Sometimes even having an aged inventory helps with that. The next item is sort of your equipment, making sure that you properly track all of your equipment, that entries are posted there, and that you really make sure that you have that piece of the puzzle and understanding what all your fixed equipment costs are. Now, that is by no means an all-inclusive list of what you might see on the asset side of a balance sheet, but that is really sort of a base level for a lot of people who might be on this call who are getting into business to really help focus on. So now focusing on the accounts payable or the liability side, is the first item to focus on is accounts payable. So often, as I said, this is really your amounts due to vendors, due to maybe suppliers, maybe other bills such as utilities. And a lot of times I recommend using sort of an accounts payable sort of module, is because by tracking your accounts payable, you can really have an understanding of how much money you owe to people, which impacts your cash flow and how much you are going to pay out. Some people just track expenses as they actually pay them, which if maybe you have a stack of bills in the corner that you've been maybe ignoring for a couple of weeks, is often you may not have a full idea of what the picture of what your future cash flow is going to be. Also, if you're trying to really establish what your margins on your sales are, is if you have a whole bunch of bills to vendors where you're not entering them, you may think, oh, my margins on this are pretty good, but only to realize later on, geez, my margins were not where I thought they were. I thought my margin was 25%, which I felt comfortable with. But now that I'm getting caught up on all these bills, it's actually 20 or 15%. And you're really missing the picture. The next item is sort of what your liabilities might be to the government. So if you are in business and are not a small supplier, so you might have HST and or payroll concerns. So there's a couple things I sort of sometimes recommend to businesses, especially if you're really concerned about managing your cash flow and sort of understanding what your liabilities are. So whenever you collect HST from someone and are in a position that you need to remit that to the government, whenever, if you have employees who work for you and you deduct CPP, EI, and payroll taxes from them, that is not your money. That is the government's money that you are technically holding in trust for them. So what some people do is, one, they might have a separate, say, bank account in order to put any HST collected and or payroll liabilities in, to really help them understand that's really not my money in that bank account. So I'm going to use that bank account a little bit to sort of help understand that, because where we see sometimes businesses get in trouble is that they get behind on their remittances to Canada Revenue Agency. That's penalties and interest. That is not tax deductible. It ends up creating a lot of stress because CRA is usually very good at tracking people down and sending angry letters after a while. So having that understanding, and even going back to that, is making sure you understand how those accounts should look and be clearing from your balance sheet. Is a lot of times you should be able to track what you've done in a month, and as you pay that, those accounts should be, depending on the timing, clearing out. A lot of times we see these accounts get into a bit of a mess because people aren't properly posting certain things and aren't putting the proper numbers on either their HST or payroll filings. It can grow to a big problem that we are often, sometimes as accountants, adjusting at year end, trying to figure out, and it's not value added time, and it does sort of impact your business on a day-to-day basis. Other things to look out for is making sure payments are properly clearing. If you have a loan and you are properly posting payments to those loans on a month-to-month basis from your bank statement, because they may be automatic transactions. So making sure it gets recorded to the proper loan. Other items that you might have is really understanding sort of what a balance sheet should look like, how those accounts should flow, And obviously, if you have any questions on that as you're getting started, make sure to reach out to someone, a professional who can help you and really sort of help you understand what those balance sheets look like, not just from an actual external balance sheet, but also from your internal records. It's very important there. So those are a few items that I want to highlight from sort of reading financial statements a little bit. It's challenging because obviously I know different people are at different life cycles. I can't see as many people's faces to see if they're sort of looking stunned, or it's like he lost me, or if I'm with them, but that's fine. Again, that's what the chat is for. Again, what I've sort of touched on a little bit so far is really from starting your business. And again, those are things that even people, if they've been in business for a while, is really helping them understand sort of what their financial statements look like. The next item sort of I want to talk about from an accounting standpoint is what it might look like at a life cycle for anyone on this call who might be sort of looking towards sort of the back end stage of their business. Maybe their business is a little bit more mature, but it's struggling and they're thinking, geez, here I am, I've been in business for a while and I'm trying to figure out what my retirement strategy is. So a lot of times with that on the accounting piece is one, is your business marketable to someone else? Some people, and how does that impact the accounting? A, trying to make sure those accounting records are clean and that the financial statements are clean. Is there a market for my business? Do I have the ability to sell my business to someone else? And what that might mean for my retirement. Or if there isn't a market and this is really just going to be, I've built up a bunch of cash in my business and or investments, is how is this business going to fund my retirement? How does that flow? And how can I do that in the most tax efficient way? The next item is really, even if you're not quite at the retirement stage yet, but your business has been, say, if you're in a point where my business is really successful, really is highlighting, okay, you want to take advantage of that success. I want to take advantage of some of that money is really establishing sort of understanding the impact of short-term tax consequences versus long-term tax consequences. What a lot of business people, what we often find, and sometimes where even I wouldn't say get into maybe disagreements with our clients, but a lot of times where some people give them varying advice is some people are so anti-paying tax, they're so against paying tax, so this is my money. Sometimes people give them strategies to pay very little or almost no tax in the short term, and people think, geez, this is great, I'm not paying any tax. However, that may have negative long-term consequences. They may end up paying a lot more tax in the future. They may pay $2 in the future just to try and save $1 today, because sometimes people get overly worked up in terms of saving the dollar today. Excuse me 1 minute. So I would say, as you sort of get a little bit into your business, as you get a little more stable, is establishing really what my short-term strategy is from a tax perspective versus my long-term strategy. So now just going outside of the pure sort of accounting standpoint is really talking about some compliance issues that you want to sort of understand. First off, with sort of any HS, a lot of times there's a few things that people maybe don't fully understand when they get into business and are sort of playing catch up later. Is if you have employees, is before you have an employee, before you even think you might have that put in place, and if you're whether incorporated and or a sole proprietorship, if you're a sole proprietorship, and if you're not incorporated, anyone who's in this place where you say I'm a sole proprietor, is you don't go through payroll. All of your payroll taxes, all of that's done through when you file your own individual tax return. If you become incorporated, you may choose to be an employee, but you don't need to be an employee. You may choose to sort of flow out funds to yourself by way of what's called dividends as you sort of start your business. But if you do plan on having employees, people who work for you, is the last thing you want to do is to be in a situation where you're calling someone up and saying, John, I have someone who's been working for me for a month, and I need to pay them. They're my employee. I haven't registered for payroll. What do I do? Well, what you do is you get in a time machine, and you should have registered for a payroll a month or a couple months ago is what you really should have done. Is you want to make sure you're registered for payroll in advance, in order to make sure that you're not scrambling at the end if you do have employees. You don't want to register too far in advance to be filing a whole bunch of no tax returns. But if you do plan on hiring, basically say the month after, is getting that payroll account in place. When you get a business number, a lot of times your payroll or maybe your HST won't be automatically put in place. You need to register for them separately. The same thing registering for HST. If you are a small supplier under 30,000 and it's going to be really something there, you do not need to register for HST. But if you are going to have, say, sales of more than 30,000, in most instances, again, there's certain unique situations out there. Again, as Brianna did mention, that there are some people who are registered from California. I can't really speak to anything outside of Canada in terms of your tax considerations. So if there's someone who's, although it'd be very early in California right now, if you are on this call, or anywhere else, is that or anywhere in the US, I can't speak to that as much. But if you are in sort of, for the most part, in most Canadian provinces, that you need to be registered for HST, and or in certain provinces, just the GST aspect. If you do business in Quebec and do significant business in Quebec, you might have QST concerns. It's not something we deal with a lot, but it is something that you should be aware of. Because the one thing when you register for HST is you are also able to claim input tax credits as a business on any HST you pay. So the later you register for HST, the more those input tax credits could potentially be wasted. So that's a few considerations when sort of starting up your business.
John, there is a question in the chat. Did you want to answer the questions at the very end, or do you want to?
I can address that question now. So I see read the taxes, i.e. short-term versus long-term strategies. Was that related to business or retirement? And I apologize if I pronounce this incorrectly, casita. So really that relates to a lot of cases to both. Because on the retirement aspect, I'll just give this as in a quick example. And I'm just going to minimize the chat here. So really the aspect of that is really tax rates go up on a graduated basis in Canada. So as an example, for an ordinary income is if you have ordinary income over $220,000, that is taxed at a rate of approximately 54%. That's a pretty significant number. That would be over 50% of your regular income over that amount going to the government. So, and that goes up. Once you sort of reach the mid 80s, is those rates go gradually up from sort of the low 30s, mid 30s, up into the 40s. So, so when you are in a position where you might have, say, some people may say, I want to pay very little in tax at the start. So I'm only going to declare income to me of, say, 20,000 and almost pay zero personal taxes. And they think, oh, I'm paying no taxes, that great. But they've grown, then they grow their business to be somewhere successful and be like, all of this money is in my company. And I actually want to utilize this personally. I want to take something out. I want to maybe build a cottage. And now I'm taking a whole bunch of money out and paying tax potentially at those much higher rates. Whereas you might have made a decision to say, you know what, I'm going to take a little bit extra in the short term, even if I don't actually need to physically take that cash out of my business, but the business would then owe me that money. So I pay a little bit of tax at the start at lower tax rates. So I'm avoiding if I want to take out a bunch in the future of paying those higher tax rates. And that flows a little bit into not just retirement, but also even before retirement, once you maybe, knock on wood, hopefully build up your business to be successful. In terms of that business aspect, you said relating to business is often you may have some strategies to pay little taxes from a business standpoint. So some people say, hey, John, if I buy some equipment so I can get a write-off for that equipment before year end, it's like should I do that? But they may be putting their business in a very poor cash flow position if they need to buy a $50,000 piece of equipment that they may or may not really need just to save a few dollars on taxes. So it's just really about not being always overly tax driven. It's about making good business decisions while making sort of having a proper tax plan in place and minimizing taxes with good business decisions. Next question, and again, I do have a couple of other items, but what kind of channels are used to buy and sell small businesses, and what are the fees and taxes for consideration? So again, when people say channels is, so if it was a, say, small business that was incorporated, a lot of times people buy businesses in sort of two ways. Is one, they may buy the assets of the business, which could include, for example, inventory equipment, as well as potentially the goodwill in the name, and or actually buy the shares of a business. Sometimes where people may just want to buy the assets of the business is there may be some concerns with the liabilities, because if you often buy the shares of the business, and I'm just speaking of an incorporated business, is a lot of times you are buying potential liabilities that you may not know about. A lot of times, especially with bigger businesses, there's a lot of waivers, there's a lot of other things in place. But when you often sell shares, you do potentially have use, and again, potentially not in all situations, of what's called a qualified small business deduction. So if you've built up your business over time, and you sell these shares, is that there are certain exemptions for small business owners where they do not need to, for the most part, there's some minor variations, pay tax on a certain amount of that small business, which is indexed to inflation. If you are just selling the assets, if you are incorporated, so that corporation would sell the assets of the business, the cash would go into that corporation which you own, and then obviously it would be, you would decide how you take out the cash on that business. A lot of times there might be a gain when you sell the assets, and a gain. So that's just, a lot of times there's a little, it's in not all situations, but a lot of times sellers of business, if it is incorporated, try to sell the shares of the business because it's more favorable to them. And a lot of times purchasers want to sort of not purchase shares, but want to, in certain cases, purchase assets of the business because they're in a position where they don't want to take on those liabilities. If it's a sole proprietorship, and a lot of times, and again, this isn't clear cut, this isn't cut and dry. A lot of times you don't see sole proprietors sell businesses as much because they're not as big. Once people sort of grow to a point, they're often looking at incorporating. So there's not often a ton to sell. Usually it's very much just selling the assets. You might have a little bit of a gain there, as well as maybe selling a little bit of goodwill, which is then reflected on the personal tax return. And again, that just flows into your own personal tax situation. You said if demand for business is unpredictable, you have any tips on how to work with the situation? I'm not quite sure what is meant by that. If that is saying okay, if that is saying if the demand for business is unpredictable, if that is saying that the sales vary widely on a year-to-year basis, is really okay. It is difficult to forecast sales volume, correct? Okay. So sometimes people may say, okay, they may use, say, last year's financial statements as a basis for determining a sales price that you're comfortable with. In that case, in actual valuation of the company, you may want to go a few more years out. You may want to sort of factor that in. You may want an actual formal valuation that has a little bit more idea in terms of the volume. And you may also want to make sure if, say, someone is purchasing a business, because often the sellers, you have more concern with the if you're purchasing a business and then the sales are completely drop and or disappear, is that making sure that there's contracts in place. Again, if it's unpredictable, is there can be sometimes even certain things, although there are certain tax consequences to this, so these need to be taken into consideration. There may be even certain factors where you can say, okay, purchase price is X, say 50% of the purchase price is driven by this, whereas 50% is contingent on the sales numbers. So you may want to factor in, okay, retention of actual sales over a certain period of time in order to sort of have that business sales number. So that way, if sales fall off the board, is that if you are a purchaser, that you are not buying a business that almost has lost half its sales. Once you get past, say, a 2 or 3 year period, if you're selling a business, you say, no, that's on you to sort of retain sales. If you can't retain sales, upon 2 or 3 years, that's just because you are doing a poor job at managing the business and managing these customers. But really on a short-term basis, you may have that in place. Other than that, it's just something riskier that you need to be comfortable with if you are a purchaser, and something that you need to consider from a purchaser's perspective if you are selling the business. Other question I have is, how does one account for dividends versus wage? Same taxes apply, CPP and income taxes. So no, that is not the case. And this only applies if it's an incorporated business. If you are a sole proprietorship, there is no concept of dividends. It's really, it all flows into your income. So what that means is, if you are incorporated, and I'll just use this as a very simple example, and say if your business, before you take any compensation for yourself as an owner, makes $100,000. But you say, you know what, I want to take that all out of the business. So 2 ways to do that. One is by way of dividend. So what you would need to do in that situation is the $100,000 in the corporation pays corporate taxes at a rate, small business rate. Again, this is based on the province of Ontario, assuming you're eligible for the small business rate, of basically just around 12%. The remaining amount of those funds would be flowing out to you as a dividend. You do not pay CPP or income taxes as a payroll deduction when you take out that dividend. It goes on to your personal tax return as a dividend, and you pay your income taxes when you file your income tax return. Again, if you're always doing a dividend strategy, sometimes the personal taxes CRA will want you to make installments, but that sort of goes outside of this consideration. If you decide to say, you know what, I want to pay myself out that full $100,000 as a salary, is essentially what you would really do is you probably have about a $93,000 salary. Approximately a $96,000 salary. The corporation would pay their portion of the Canada pension plan. You would deduct your portion of the Canada pension plan off yours, as well as payroll income taxes. And that's what you would get, just as if you were an employee. The corporation in that case, and again, I sort of designed that so the corporation does not pay any corporate income taxes. And it's really designed under what's called integration to get you to the same point from a cash flow perspective, although it's not quite perfect all the time, is if you did a salary, as if you did the both things. Couple things that salary does, which if you are, say, really trying to manage your cash flow at the start, is when you are an incorporated and or even a sole proprietor versus say, you know what, I was an employee before, I'm going into business on my own, I'm going to strike it out because I'm an entrepreneur and this is what I want to do, is when you were an employee, is your employer paid the employer portion of the CPP. When you are a business owner, if you want to take out a salary, is you pay both the employer portion as well as the employee portion. So that, if at the maximum rates, which is in the sort of mid 60,000s, the actual CPP on that is approaching basically the $6,600 range for 2022. That can be a pretty significant chunk of cash flow from your business if you are trying to do that early on. Dividends do not attract CPP. So some people may say, you know what, I am very good at managing my money. I want to manage my cash flow at the start, and I am very able to plan for my my retirement by managing my own money instead of giving it to the government in the form of CPP and having them management. And some people make that decision when they go the dividend route, because basically they have extra money offhand in their own personal hands to sort of manage their own finances. The downside to that is you may get to the point where you retire and you may say, John, it's like all my friends, now that I'm retired and I'm older, all my friends are getting this CPP check and I'm not getting anything. It's like, why is that? It's like, I don't have any money. I'm not getting any CPP money. It's like, well, remember we had that dividend strategy in place. You saved all that money. And they may say, well, I wasn't very good with my money and spent all of that extra savings I should have had. So really understanding yourself is important, because the same taxes CPP does not apply. The same for both dividends as well as wages. RSP room is not generated by dividends. So it's really just important to sort of have that understanding of those different strategies, as well as really having enough self-awareness to really make sure that if you go down one route or the other, that it is appropriate for you. Because I have seen, although some of my clients are younger, but I have seen older clients where what they should be saving from that dividend strategy route, they haven't necessarily been saving, and it will ultimately impact their cash flow in retirement because they may not have that same CPP in place. So I think that covers off what's in the chat right now. So I've got about 10 minutes left. So the last thing I wanted to quickly sort of touch on from the sort of accounting business aspect is the idea of incorporation versus not incorporating. So really a lot of times, and again, what I'm telling you today is really generic, and you should always go out and sort of talk about find a professional and talk about your own individual situation if you're getting to this point. But a lot of times there's a couple reasons why people decide to incorporate. Is one, there's a liability aspect. And again, I'm not a lawyer, but a corporation is a separate vehicle from your own individual entity. Especially if you are getting into a business where there is a higher risk in place. And again, always make sure you look at insurance, make sure you have proper liability insurance in place. I'm not an insurance salesman. I'm just telling you that make sure you just say, I'm doing this so I don't need insurance. That is not the case. But really from a liability standpoint, if you have a riskier aspect going into that standpoint. Also, if you are really getting into the position where you want to grow your business, is again, you may want to have you may want to get financing, you may want to get other things in place, and you may want to have a separate entity to have that in place as you grow your business. Again, if for those of you who are on the call at the start, Trendval is there, often provide a lot of support, not always to corporations, but sometimes to sole proprietorships, but just making sure that you have that sort of vehicle where, because sometimes when you are a sole proprietor, all you are focused on, because all you really need to track is your income and expenses from a tax standpoint, because it's the same vehicle as you. But when you're incorporated, having that little bit extra push to really track how much cash, your liabilities, your assets that your business is generating, it really helps with that aspect. So I really want to sort of focus on that. From a tax aspect, as you grow your business, and if you are earning a lot more from that business, when you are sole proprietor, you pay tax on what you earn. There's no deferral. There's limited deferral opportunity to grow your business, which when you have a corporation in place. If you remember, and again, I'm speaking primarily based on Ontario small business rates, assuming Canadian controlled private corporation. If someone has a little bit of a weird situation, don't come back to say this guy said this would be my tax rate. No, I'm giving it based on the most common situation for anyone who's likely on this call, is that that small business tax rate of 12, just over 12%, is if you want to keep money in your business, to grow your business, to generate more money, to be able to reinvest in assets that help you generate a return on that investment, is really having that opportunity to defer that income is really important. So so those are just a few highlights. So that concludes really I want to talk about. Are there any other questions that maybe anyone wanted to just punch in quickly in the chat?
John, it's Amber. I liked your comments regarding keeping those funds separate from in a separate bank account for the HST and any payroll costs. Anything that you actually collect for the government is a great thing to keep separate. And we find many clients don't, and they actually start using that for cash flow. And you know, having that separate bank account was some great advice. So thanks for that. And I do have another question for you. I do notice that some business people register their business name, such as mine, Amber Darling, but then they also have other things like Darling Enterprises or whatever. Do you have some advice for people when registering a business name, and when it becomes an issue for legalities if you're using your own name versus a business name?
I can't really speak to legalities in terms of legal but when you say a lot of times people may just register their own name or something close to their name, and really, but that's really not tied in to an incorporation. In terms of if you mean by legalities, is a lot of times there's the difference between incorporation and making sure you are properly incorporated versus unincorporated. So someone may have their name and for business and trademark and or just for business reasons, they may say Amber Darling Tree Services versus Amber Darling Tree Services Limited, or say incorporated. So oftentimes if you incorporate, is make sure that you need a new HST number. Your HST number doesn't automatically flow over from your sole proprietorship. Your payroll account number doesn't flow over from your sole proprietorship. Is you now have a completely separate entity, and any of your invoicing should have those new numbers on it, as well as the sort of Inc. Ltd. Limited versus just maybe your name, even if for branding you've kept a very similar name. A lot of times it's the difference between, also some people may say, yeah, I registered my business name, and they may think that means incorporated. It doesn't necessarily mean incorporated. It may just mean they've registered it with, say, the province of Ontario, because they want to sort of just have that almost, I don't want to use the name trademark, but have that in place. So a couple items from the chat. Can I please repeat what I said about the 12% taxes at the end? Not sure I understand what was said about the deferral. Okay, so what I'm going to do is just use that, say, 100,000 figure again as an example. So let's just say you've saved up a lot of money, or at least enough money from your own individual. And again, this sort of goes a little bit outside of proper tax planning. So I'm just trying to simplify this to give the hopefully most clear answer is, so say if you were unincorporated versus incorporated. Say if your business made $100,000 and you don't need to take any money out because you have enough savings. Again, like I said, outside of any tax planning, is that if you are incorporated, you would pay approximately 12% of that in corporate taxes. So you basically have 88,000 left to reinvest in your business going forward. So whereas if you were a sole proprietor, in that case, is between income taxes, between CPP, is you would probably be in the position where about, instead of 12,000 of that being paid in tax, at least probably 30,000 would be paid in tax in that case, tax and CPP. So you would only have 70,000 to reinvest in your business. Again, I don't have the exact tax tables right in front of me. That's probably within the general range, but that's just really what I mean as an example. So there's a difference of, from that pure, say, sole proprietorship versus incorporation decision, is you are at a point where you are losing out on, in that instance, $18,000 to potentially reinvest in your business, to maybe buy new equipment, to maybe buy inventory that's going to get you a return. And I've got one last question before Brianna cuts me off. I see her unmuting herself, ready to give me a boot. Newbie question from Sarah, the only other face I can see on this chat right now. So I understand that for a partnership, sole proprietorship, that taxes are done on income at the end of the year. Is there CPP and EI deducted at the same time based on yearly income? As a sole proprietor, typically there is not EI. You can't really fire yourself and collect EI. So there isn't EI, but yes, in 99% of situations, CPP is calculated at the end of the year, and that's based on your income. So typically, it for the longest time was about 4.95%, which is just the, if you were a employee before, but as a self-employed person, you pay both that percentage, and that is over 10%. But that is capped again in the mid 60s. So if you made, say, 100,000, it's not 10% on that in terms of CPP. It's capped at the mid 60s, which is approaching the sort of between the employee portion about in the 6,600 range. So that is added on to your income tax at the end based on self-employment earnings.
So, John, first of all, I want to say thank you very much for today. And I have a question. Say that someone has another question specifically either for you or for someone at your office. Can I give everyone, all the attendees here, your contact information, or someone specifically from the office that can handle some of these questions they may have?
If it works out for you, Brianna, just what I would recommend is, if there are questions, if those could maybe be just directed to you, in that way, because what can be helpful for us is, just because there might be a lot of people in a similar situation here, is you may be able to get, say, you may get 10 questions and 5 of them are the same. And that way, if you filter them, and that way I can come back with an answer, and we can almost even have sort of after the fact, if there's like an FAQ, and to be like, here's 3 common questions we had, and here's a little bit of a general idea. That'd probably be the best approach. If someone's really getting into be like, hey, I need to reach out to a John or someone at Wilkinson, we are certainly here. We are here to help. We are extraordinarily busy, and it is it can get a bit stressful. We're continually trying to, but we are here to grow and help out small business owners. So if it's someone where someone's like, hey, I want to take that next step or incorporate and need to seek professional advice, we are certainly for that. But if it's just general questions, if you could filter them, because there might be 10 of the same questions, that'd probably be the best approach.
Sounds good. Thank you. I hate to cut you off, but we need to keep on a set schedule here. We'll have a 15-minute break.
I'm done.
You're done. You can get back to work in the office.
Yeah. Have a wonderful day, everyone.
Thank you very much, John. And everyone else here, thank you very much for attending our first session. We will have another one here coming up here shortly. Right at 10:15, we will have Alyssa's walk. So everyone here, I also, within the email that I sent out with the Zoom link and today's schedule, you'll see right below on the schedule, Alyssa Zonk, there is a link right there. There is a worksheet that I would like everyone to kind of just take a quick glance over, and she will be referring back to that worksheet in about 15 minutes from now. So if you want to go run to the restroom, grab a snack, grab a coffee or tea, you're more than welcome to do so. We will see everyone back here at 10:15. Thank you.